Most people believe the financial system is built on math, fairness, and predictable rules. They think money moves because millions of us collectively buy, sell, save, or invest. But what if that's not the real story? What if the real power of the global economy sits inside a hidden engine you never voted for, never approved, and never even saw? What if the comfort, chaos, inflation, and panic you feel today comes from a system that operates silently behind the scenes, deciding who loses, who wins, and who is allowed to rise? That is the reality behind the hidden engine. Let me ask you something. Why do asset prices rise even when ordinary people are struggling? Why do markets bounce back faster than families can rebuild? Why do banks get rescued even when the public is drowning in debt? These questions sit at the center of a mystery that no traditional financial textbook will ever explain. But the answer is real, and it has shaped your entire life without you even knowing it. Today we go into the truth. Today we unpack the one mechanism that has been steering your wealth from the shadows. Before we dive into the heart of this, let me know where you're watching from, because this story hits every city and every country. And if you want more unfiltered truth with no watered-down explanations, hit subscribe, because this is the type of breakdown almost nobody is willing to give you. To understand the system that controls your money today, we need to travel back in time, but we also need to look at the present through a clearer lens. The world has always been shaped by invisible financial tools, but in the early days, they were simple. A king borrowed gold, a merchant borrowed silver. A lender took collateral. But by the time the modern banking world came together, something new was forming. A machine so complex and so layered that only insiders could operate it, and only elites could benefit from it. Take the early central banks. They were sold as protectors of stability, keepers of order, and guardians of currency. But in practice, they were engineering something else, a system where liquidity could be manufactured out of thin air and directed toward chosen institutions. Sound familiar? During financial panics, the elites got rescued first. Ordinary people got rescued last, if ever. Sound familiar? When banks took risky bets and failed, the public took the losses, while the banks returned the profit within months. Sound familiar? Across history, the same pattern repeated. Those closest to the source of money enjoyed protection. Those farthest from it suffered the consequences. But what changed everything was the invention of a new financial layer, a shadow layer, a place where money could move without rules, oversight, or political resistance. You know it today as the derivatives market, the dark twin of the financial system, where banks use paper to control real assets, and where risk becomes invisible until it's too late. This is where the hidden engine was truly born, the mechanism that now controls your wealth without your permission. The modern world runs on what insiders call the derivatives liquidity grid. It sounds technical, but the idea is simple. Banks, hedge funds, clearing houses, and central banks trade trillions of dollars worth of contracts every single day. These contracts sit on top of the real economy like a giant spider web. When the web is stable, everything looks normal. When the web shakes, jobs disappear, savings evaporate, and markets crash. Nobody shows you the web, because if you saw how fragile it really is, you would never trust the financial system again. This grid isn't just big, it is massive. The official number often quoted is around $600 trillion in global derivatives. But insiders know the real number, counting every swap, every synthetic position, every off-book contract is closer to $1 quadrillion. That's 1,000 trillion. That's more than 10 times the size of the entire global economy. And this system is what decides the direction of your wealth. Here's the part that will shock you. Derivatives were not created to protect you. They were created to protect institutions from you. Banks use derivatives to shield their wealth from bad decisions. Corporations use derivatives to hide debt and inflate value. Governments use derivatives to manipulate interest rates and make budgets look stronger than they truly were. Think about the famous case of Greece. Before the 2008 crisis, Greece used complex swaps engineered by a major American bank to hide billions in debt so it could qualify for European Union rules. When the lie collapsed, ordinary people paid the price through austerity. Retirements were wiped out. Jobs vanished. Families were forced to live on half their previous income. But the bank that engineered the contracts made hundreds of millions in fees. This is the hidden engine working exactly as designed. It's not a glitch. It's not an accident. It's a design. Now, let's bring this story closer to home. In 1998, a hedge fund called Long-Term Capital Management almost brought down the global system because of derivative bets that went the wrong way. It took 14 major financial institutions and the Federal Reserve working together to stop the collapse. A single hedge fund almost broke the world. Why? Because derivatives magnify risk in silence, then explode all at once. Banks promised they learned their lesson. But by 2008, the same machine had grown even larger. Mortgage-backed securities were piled on top of synthetic swaps, which were piled on top of CDOs, which were then wrapped in insurance contracts like AIG's infamous credit default swaps. When the truth came out, $62 trillion in contracts were at risk of default. Again, ordinary people lost their homes. Families lost their savings. But the institutions that built the mess got bailed out. Why? Because the hidden engine must be protected. Not you, not families, not communities. The engine is the priority. And here's the darkest part. After 2008, regulators claimed they were rebuilding a safer system. They said risks were being reduced. They said banks were being forced to shrink their exposure. But inside the shadow banking world, the opposite happened. The market grew. The layers multiplied. New products were invented. And the global derivatives engine expanded by more than $200 trillion in notional value over the next decade. That expansion was not accidental. It was intentional. Banks discovered that derivatives gave them the most valuable power in finance: the ability to create liquidity without touching physical money. With derivatives, they could amplify assets, multiply leverage, and engineer profits in ways the public could not understand. This is the modern version of alchemy. Instead of turning lead into gold, the system turns risk into wealth for some and crisis for others. Think about the repo market crash of 2019. Overnight borrowing rates exploded from 2% to 10% in a matter of hours. Why? Because giant institutions that usually supply liquidity suddenly stopped lending. The Federal Reserve had to inject more than $200 billion to stop the bleeding. Most people never heard about it. But those inside the system knew exactly what happened. A hidden chain of derivatives had tightened so much that the system almost choked. This wasn't a random event. It was a warning shot from the heart of the engine itself. You're seeing the effects of this hidden grid, a system that prioritizes its own survival over everything else.
Then came 2020. The world stopped, markets plunged, and in response, central banks unleashed the most colossal liquidity injection in human history. Over $5 trillion, created from thin air, was pumped into the financial system in less than a year. But where did that money go? Not to families struggling with lockdowns. Not to small businesses on the brink of collapse. No, it went straight to institutions, to the markets, to the people who already held the assets. The hidden engine was fed and watered before the public was even a footnote in the plan. While people lost their jobs, asset prices soared to new heights. While Main Street businesses were boarded up, billionaires saw their fortunes explode. While citizens lined up for help, the global derivatives grid, this invisible web of financial bets, grew even larger, even more complex. It is now so vast and interconnected that a single institution failing can trigger a global meltdown in minutes, not days. This is the uncomfortable truth of our time. Your wealth, your financial future, isn't primarily shaped by how hard you work, how much you save, or even how wisely you invest. It's shaped by a hidden machine that moves trillions of dollars above your head every single day, without your knowledge and without your permission. So, let's go deeper. Let's pull back the curtain and break down exactly how this mechanism works. Imagine the entire financial world, the one you know with stocks and bonds. Now, picture a massive, unregulated casino built right on top of it. That's the derivatives market. In this casino, banks and financial institutions don't play with normal chips. They play with leverage. Instead of betting $1, they can control 100 or even 1,000. Instead of actually buying and selling assets like gold or stocks, they just trade the price. They make bets on where interest rates will go, how currencies will fluctuate, the price of oil, the risk of a company defaulting, literally anything that can be turned into a prediction. When they win big. But when they lose, the system itself steps in to cover their losses. Why? Because letting them fail would mean destroying everyone else along with them. Economists have a clean academic term for this: moral hazard. The public has a much simpler term: unfair. But for the insiders, the people running the casino, this isn't a flaw in the system. It's the system working exactly as intended. To truly grasp how deep this rabbit hole goes, consider this staggering fact: just 4 American banks control 88% of all global derivatives. That's not a coincidence. It's a concentration of immense power. It means 4 institutions effectively hold the keys to the main engine that drives global liquidity. And it gets even more shocking. A jaw-dropping 94% of this entire market is made up of over-the-counter derivatives. This means they aren't traded on a public exchange like the New York Stock Exchange. No one sees them. No one effectively regulates them. And no one can accurately measure the real risk they pose until it is too late and the whole thing explodes. This isn't just an industry. It's a shadow kingdom operating beyond public sight. Let me give you a concrete example of how this works. Imagine a large bank gives a big loan to a corporation. The bank wants to reduce its risk, so it buys something called a credit default swap, basically an insurance policy from a hedge fund. But the hedge fund doesn't want to hold all that risk either, so it offloads a piece of it by buying another derivative from another institution. This chain reaction can continue, creating dozens of layers of hidden contracts and silent liabilities, all stemming from that one single loan. Now, imagine this happening with thousands of loans, creating millions of interconnected contracts, all linked together in a giant, invisible network. When just one piece of this complex web collapses, the shockwave travels through the entire system almost instantly. This isn't a hypothetical scenario. This is exactly what happened in 2008. And it's exactly what could happen again, but on a much larger scale. Let's look at the sheer numbers, because they are almost too large to comprehend. According to the latest data, global interest rate derivatives alone represent more than $500 trillion in notional value. That's $500,000 billion. For perspective, the entire world's GDP is around 100 trillion. Currency derivatives add another 100 trillion to the pile. Equity and commodity derivatives add trillions more. Every single day, the trading volume in the derivatives market exceeds $7 trillion. That's more than the entire annual economic output of countries like Germany or the UK, traded in a single day. And here's the statistic that should concern you the most. Less than 2% of all these contracts ever result in the actual delivery of the underlying asset. The other 98% are pure bets, layered on top of other bets, creating a skyscraper of financial illusion built on a tiny foundation of real-world assets. This isn't finance in the traditional sense. It's something else entirely. It's a global betting parlor where the house never loses. Now let's talk about the moral hazard that's hardwired into this machine. When the system gets this large, regulators and central banks are forced to provide a safety net. But that safety net isn't for you. It's not for the public. It's for the very institutions holding the most risk. That's why the phrase "too big to fail" exists. It's not just a description. It has become an unbreakable rule of modern finance. When a major institution gets its bets wrong and its derivative exposure threatens to bring down the whole system, the rescue is automatic. It's not a choice. It's built into the logic of the machine. And where does that rescue money come from? It comes from you. It's siphoned from your wealth through inflation, which devalues your savings. It comes from your taxes. It comes from reduced economic opportunity for everyone else. It's the ultimate transfer of public risk into private profit. Just look at the 2008 bailout. The public was told that $700 billion was authorized through TARP to save the banks. But behind the scenes, the Federal Reserve quietly injected more than $16 trillion into the global banking system through secret swap lines and liquidity programs. Most people never even heard that number. But that is the true scale of the hidden engine. When it needs money, it gets it, no questions asked. Now, fast forward to today and imagine the next crisis. Imagine a scenario where interest rates rise too quickly, causing trillions of dollars in derivative positions tied to those rates to rapidly unwind. Imagine a sudden currency shock that rips through the global swap system. Imagine a liquidity freeze in the shadow banking world that brings credit to a halt. These scenarios aren't just wild speculation. They are mathematical probabilities. In a system this leveraged and complex, they are inevitable. And when they happen, they will affect ordinary people long before the public even understands what's going on. Because when this system shakes, the first victims are always the workers, the savers, and the families on Main Street. This is the ultimate consequence of trusting institutions that are built on borrowed time and powered by illusion. This is the danger of believing that financial stability is a natural state, instead of something that is precariously engineered behind closed doors. The hidden engine keeps running, keeps growing, primarily because most people either deny its existence or feel powerless to understand it. We assume the system is too big to break, the people in charge are too smart to fail, and the mechanics are too complex for us to comprehend. But denial is the most dangerous luxury in finance. It blinds you to the truth. It blinds you to the real risks brewing beneath the surface. And it blinds you to the powerful, invisible forces that are shaping your life and your future without your permission. So, this brings us to the final critical question. A decade and a half after the last great crisis, are we any wiser? Or are we just walking the exact same path, maybe in better suits, toward an even bigger cliff? If this breakdown opened your eyes to the financial reality we're living in, share your skepticism in the comments below. And be sure to subscribe so we can continue exposing the truths they don't want you to see. Thanks for watching.